You know what time it is? It's another Monday, and we're giving you another free episode of great entertainment, education, and content. We're firing our way today. Good moods, high spirits. Having a window open into my office to let fresh air in. This is a rarity. It's that time of year. It's fall, finally, and it's lovely out. It's so lovely out that it's golf and football season. Before we get into the show, quick little bit of housekeeping. You may or may not have seen a deal come live. So if you have any questions pertaining to that, let me know if I can help in any way and try to get in as soon as possible. Soft commitments do not mean you are committed into the deal. So it's all about funding, and preferred return clocks for Lone Star Capital do start to accrue once you fund in the deal, not at closing. So that's your incentive that you are owed a return at that point of funding. Just want to be very clear on that. I have a ding right there. We're going to eliminate those today. So I do
No
apologize.
dings today.
No dings. No dings at all. Other two topics. I'm starting to get a bunch of emails actually from people in the space asking for two conferences, as a matter of fact. One being Ascent in South Florida and Miami, which is more institutional. Rob and I will be in Miami. So the first weekend, the first couple of days in November, I believe that's the day of daylight savings, which I guess I thought was going away, but still there. At any rate, November 3rd, 4th, and 5th, I believe will be in South Florida and Miami and for Ascent. So if you're going to that, look forward to meeting you there. If you don't know what that is, email me and I can explain. And then we're going to be at Sam Silverman's event, fully funded, where Rob and I will have the stage for different items. Rob will be giving a keynote speech. I think I'm going to be on a panel, might be moderating a panel. Whatever Sam needs us to do, we are going to be happy to do it. So Sam is a great friend to the show, a great friend personally, leader in the industry in many respects, a thought leader. So it looks like he's already got a great cast of people going to the event. But buy some tickets if you're looking to go. If you're in South Florida, the room will be pretty solid from what I see so far. So that's of interest. You should be there. And I'm looking forward to that conference already and our South Florida trip. Not a bad time of year to be there.
It's perfect time. Yeah, and I was looking at the agenda that Sam's putting together for the event and the guest list. And isn't it just so much more appealing when you see the guest list and it's not 500 people and it's just manageable and you see good name, good name, good name. It's kind of like our conference. I don't know if that's necessarily a trend. I feel like conferences generally have the tendency to get bigger and bigger and bigger, but really the big value comes from these smaller events.
100%. I think the biggest event I would want to go to would be like Ascent, which is like probably 200 people. Don't really want to do anything more than that. I would go as far as 20 people as well. The quality is not in the quantity. The quality is in the quality is in the quality. I guess the only way I could say it.
Well, that's the thing that is so impressive about Ascent. They just do an amazing job of bringing so many people together, yet the quality of the average person is so high. And then the event is so well organized that you don't get lost and you can still have the opportunity to meet the people that you want. And they're very intentional about it too. It's like, hey, capital sits here, sponsors sit here, and then you guys connect. It's very deliberate. I mean, I took a lot of inspiration from BizNow's events for our events.
Yeah, and it seems like the caliber is more gate kept at Ascent for what it's worth. And just to go back to that event, or to keep on that event, I should say, it is, I think, to a certain extent, application only or invite only. And they're starting to reach out to some people in our network, like JC got asked, Sam Brown was asked what was going on, if we advise it, if we think it's a good event, because they saw, I think, my name on the list there, which is cool. So always nice when people reach out from our network about what we go to. It's something that we're going to go this year. I think we have documented this. Moving forward, we'll be going to less and less events and making it more intentional to fly out to meet with people or to do stuff in regional areas to accommodate the same goals, and to enjoy your life a bit more and mine, as I was on the road a little bit too much this year. But that's what's going on there. And if you have any questions about partnering with us, I actually want to also direct your attention to a podcast that I just did with the Tribevest folks, Seth and Travis of Tribevest. Awesome guys to start with. But what's also really cool for you, what's important, is the value that they're providing now moving forward to the fund managers. So if you are a fund-to-fund individual, a fund-to-fund guy or gal, person, a they, a them, that will be a great kind of blueprint from an educational perspective to the changing landscape as to why fund of funds are in place, and the latest and greatest with partnering with Tribevest. There's a lot of options, not many good ones out there right now. We deem that Tribevest is a good market option right now. The cost is very awesome for what they're providing in the solution based. So for those who are looking to learn about the fund of fund or want to partner with us and understand that CoGP is just not the best means and ways to do it, there is your solution. There is your option to partner with us to help us scale, and then to help your investors get great returns. It's all about focusing on the investor, the partners, and then the compensation for all people. So we're excited that can be accomplished with that fund to fund process. If you are an investor and this means nothing to you and you're confused, don't look into it. Doesn't matter. This is just more for those capital allocators and fund managers who do in fact listen to the show, if that would be something of interest.
Very good.
Yeah. So let's start with golf and business. It's funny. I've been on a golf kick, and this is something that you wanted to connect with, I believe. So I'd be curious to hear your thoughts as to what the value you're seeing in this, because it's starting to become a very great relationship tool that I can implement here locally. And who knew we had so many great people in Phoenix we could play golf with?
Well, I was just laughing yesterday when you called me and said, yeah, golf is the new wave and you got to get on the new wave. And I told you that golf is the oldest wave, and especially golf, mixing golf with business. That's the oldest wave there is, right? And so I'm really happy that at least you're getting super back into golf, and that you're able to leverage it for business purposes. And I know when you say leverage for business purposes, it sounds very like, I don't know,
Buzzwordy.
robotic. Well, it's kind of like robotic, or like you're just using it as a tool for networking, right? And that sounds kind of very stiff and cold, but it truly is more than that. And it's effective. Like it's like you describe it. It's a great way to spend 4 or 5 hours with somebody, just get to know them outside of business. Sure, business topics can come up, and it's just a great way to connect. So yeah, I think it's kind of a staple in the business world, and golf isn't going anywhere. And it's something that you should continue to lean more into and make it a bigger thing. And so I know we talked about this last week on the show, but PSA to anybody that is in our network that plays golf, that wants to play golf, definitely let us know. We can make the rounds quite literally, and we can travel around the country. Like you said, instead of doing events and attending industry conferences, we want to be more intentional about our travel to be directed directly at certain people. Say, oh, hey, we have somebody who we want to connect with in Austin. Okay, well, let's go to Austin specifically. Let's have some good barbecue and let's play some golf. Let's hang out with them in Austin. Let's host some dinners. And one final note about that. I think I'll only play golf if they're going to invest 10 million or more.
I think that's a fallacy. I think you're not telling the truth there. I think you're really going to enjoy it. I think your foundation is great, and it's so funny because one of our very good friends was anti-golf, thought it should be 12 holes, didn't like the time of it. Now he's giddy and loves it. And I think he's starting to look around and realize, okay, well, when you've got a family maybe on the way, when you've got, let's just say, life events, and you're going to be hanging out with, in-laws, stuff like that, whatever you want to call it, people you share family with, business connections. The golf course is just the best way to kind of organically do something where everyone's kind of doing something they're enjoying or wants to be there. And then there's just the conversations on the tee boxes, on the greens that kind of come up, flavor, personalities. You learn about people very quickly. And I think Taylor Oliver, shout out to our friend Taylor Oliver, Brad's sibling, who we should have probably on the podcast, by the way, when we're in the Bay Area next, I think, for the holidays. That would be really cool to have him there, to do a podcast with him. But he's like, the relationships are so much more valuable than anything else you'll do that you'll make on the golf course. So I love that that's the case. It's great that I'm getting back into it. It's great that Lone Star is fueling my golf addiction. It's amazing. I look forward to playing in Florida. I'm going to hopefully play Miami, then also in Tampa Bay, with a hopeful guest to the podcast coming up here when we're in South Florida. So more on that. And I think we should have some more guests coming around the corner for the show. Is that correct? Because we haven't had many I can't recall the last one we've had.
It's been a nice break. The last guests were Rogers Gray, of course.
Yeah.
So that was a good podcast, actually. But I think
Great.
it's nice to take a little break from guests and then get back to guests. I think podcasts that just do nothing but guess, guess, guess. It's funny because you would think that guess are the path to variety, right? Oh, well, of course the podcast is going to be new and fresh because you've got variety, but inevitably when you just go guess, 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 it becomes rote because you end up kind of hearing the story, asking the same questions like, oh, if you were 20 years old again, what would you do differently? And it's like you hear the same questions and the same answers over and over again. It just so happens to be a different person. So I think just mixing it up here and there with guests is really just a great mix for the podcast.
Yeah, and it's funny. I obviously have the spin-off show to this, which is Fun Friday, which is guest, but I'm going to not having every single person, every a new person every single time, and the kind of what I want to do for the show is actually make it more surrounding by people that we have relationships with, that we're doing business with, that are actually in the market. Because now when I do another episode with them, it's more in depth about what they're experiencing, how they're kind of overcoming maybe objections with raising capital right now, or maybe the market, that what they're seeing. So that's more fun. To your point, it's more intentional. And the second round with these people and these guests should actually be better, in fact.
Nice. Good
Yeah.
stuff. Yeah. So that's kind of all I really had as far as thoughts with golf and business. I think it's just a really great tool. And
Well, it seems as if the really, really successful people in the space, whether you be James with the placement fund, whether you're Barrett Oakley, or Marcus, who was at our event, those guys, they got one hobby certainly, and that's golf. And the uber wealthy and successful want to play golf, and if you're good at golf, they want you out there. Fortunately, my parents invested a lot in lessons with me growing up and developing my game, so I don't have to be fighting it out on the golf course right now to break 100. I'm very grateful for that. It's a blessing to not have to, kind of eat it on the course, shank every shot, and learn the hard way. Because golf is one of those things. Not that I need to get into the way golf plays out, but golf is one of those things where it doesn't matter if you're literally LeBron James, the most athletic person in the world, or some 5'6" guy from wherever. That 5'6" guy that's got really very little athleticism in them would beat someone who's never played golf if they've been playing golf. That's the beautiful thing about golf. It is not obviously there's some people that have got God-given ability, right? Naturally, Tiger Woods probably is a lot more athletic and strong than the average individual. But if you work on your game, anyone could be good. Legitimately, anyone can. So that's the beauty about golf. It's an equalizer. It's not hey, I'm just going to muscle my way to being great. That's just not how the sport works. So I kind of love that. It's a bit of a chess play. You got to think on the course, what shots you want to hit, what shots you want to avoid, where to place it. So there's a lot more to it the higher level you get.
speaking of which, not only is it an equalizer across athleticism, right, or height, whatever, it's an equalizer as well across age. So someone who's 13 could play golf with someone who's 60. And that's one of the reasons why golf is such a powerful country club sport and why it's so amazing for kids to grow up in that environment, because you get exposure to adults, successful people, and you get to be around them in what is somewhat a little bit more of a level playing field, right? Where if you're a young guy, young kid, spending time at the country clubs, getting to know people, speaking with adults, you're going to mature a lot more. You're going to hear how adults talk. You're going to be included in more mature conversations and be exposed to more opportunity. There's classic success stories of, I don't remember if it was Steve Schwarzman or whoever, but talking about how when they were younger, they would caddy over the summers at the country club, and then that's how they got their first internship, and then that internship led to this, and before you know it, they're a billionaire. So that the country club aspect, I think, is really powerful for kids. So anyone raising kids, looking to do that, I think that's a really great advantage for your kids.
So when you start popping them out, does that mean you've reinvigorated with the world of golf?
I don't know. We'll see. Certainly, I'll be pushing my kids to play golf.
I think once you are in that phase in your life, not tipping anything here, but once you are in that phase in your life, whenever that may or may not be, you will be back into golf. I think you will see the value of it. You will be a member of a country club somewhere, and you'll be schmoozing, whining, and dining, and making really great relationships while also developing your kids and giving them a leg up in a sense. So enough of golf. I could talk about it all day. Let's get on to quarterly reports. So we've revamped them. We have refocused how our reporting is. I think we've been talking about that, but now that one is live, do you want to pull up an example? How do you want to take this away? This was kind of your idea, and I know this has been a little bit of your brainchild, and a big project you've been overhauling. So I'll let you take the floor.
Yeah. So what I want to say is, way earlier this year, I had the lofty goal before I even stepped in to take over on operations. I just, from my vantage point, I just saw the asset management team struggling with quarterly reports, and I thought, wow, this is so time consuming. It's so daunting, and I don't even really see it as that valuable. So then I had this mission that I said, I want to make our investor reporting twice as good and take a quarter of the time. And I think we're almost there. Our reports aren't perfect. Nothing's perfect. So we're open to feedback. So if you're an investor of ours listening to this and you have feedback for any of our communications, monthly, takeover, closing, quarterly report, anything of that nature, please give us feedback. But I think we have definitely gotten close to the goal where we've radically improved our communication and reporting, and it's now taking a quarter of the time. And that's not just because we've added 2 new asset managers and we have more firepower to be able to attack the project. It's also just because of the way we've revamped the templates and we've simplified things, and really just trying to simplify it. I think I talked about this on the show before, but simplify it for us and for our investors, because if it takes us less time because we've got more simple data that we're reporting on and it's easier to digest, well, not only is it easier for us to put together, it's easier for the investor to digest. They should just be able to pull it up, quickly see what's going on, and quickly see our commentary and get a sense of understanding of what's going on. And if they have further questions, they can reach out to you, they can reach out to Dasha and take it from there. So that's kind of the overarching goal of the year. So I'm really happy that this goal is essentially realized. It's going to be a work in progress, and I've got some new ideas in the hopper as well, which I'll share now. You heard it here first, but the other new addition to the reporting cadence is an end of the year report that is going to coincide with forecasting for the following year. So I'm not sure if we're going to release this. We'll probably release this sometime in December, but it's going to be a brand new report where, after me and our asset management team put together the 2025 budgets for our properties, we will then put together an investor facing report in December forecasting 2025 via the property budgets, and say, okay, hey, this is what we're anticipating for 2025. And I still have to work out the details of what this is going to look like. How is this going to be valuable for investors? But one of our top investors provided us a sample from another sponsor they work with, and they say, hey, this is a great thing that this sponsor does. This is an end of the year report with some forecasting and so on. So I want to take the best elements of that and incorporate it. Like they say, the best artists steal, and I'm a stealer. I'm stealing the best things from everybody.
Yeah, well, success leaves a clue. So that would that come in there for basically the start of the year moving forward as the quarterly? For that point, you'll probably include everything there, and then in addition to that, kind of a year-end forecasting, essentially.
Yeah, so what that would mean is there's going to be 4 quarterly reports per year, and then a 5th report, which is that, I'm not sure what we want to call it, a year-end report, or basically like a
Supplemental.
forecasting, like a forward year forecast or something. But yeah, so it would be your Q1 report. You've got January, February, March. Then your Q1 report goes out in the middle of April. And that's the other thing, is timing, which we'll talk about in a second, right? So you've got your Q1 report going out in April, then you've got your Q2 report going out in July, and you've got your Q3 report going out in October, and your Q4 report going out in January, right? But before January, in December, I want to release that, perhaps like a year-end thing, and then like a forecast, or maybe skip the year-end, because the quarters are covering the bases as far as like reviewing the previous year of performance. But certainly forecasting for 2025, that's what I need to figure out. Like, what do investors want to see? How can I make this valuable? So yeah, that would be 5 reports throughout the year. And then timing-wise, this has been a big win as well, as part of wanting to be twice as valuable, take a quarter of the time. being able to do it faster is great because we want to be able to get the data out to investors faster and communicate faster. And investors love that timeliness, and they also want to get their distributions faster. So we've been able to move the distributions from distributing at the end of the month to now kind of like between the 10th and the 15th of the month, which is really fantastic. And so that's just going like clockwork. And then we can provide coinciding communication and reports with those distributions, which is a big level up as well.
That's awesome. So I actually have a question. This is off script from what the agenda was going to be. What do you find to be more challenging? The asset management and property management and reporting side of business, or the marketing capital raising side of things?
It's a good
And
question.
try to avoid recency bias.
Yeah, yeah, fair. I think interesting question. I think the the way I view marketing and investor relations is it's like digging for gold. And so I think it's in a way it's a little bit tougher of a nut to crack, and it is more speculative. Like you don't know exactly what's going to work. Like with asset management, you kind of just need to follow a process, and you need to collect rent, maximize income, minimize expenses. You need to stick to a budget. You need to make sure you're hiring the right people. Like it's very process driven. And I think you can also boil down marketing to a process. But with investor relations, you're dealing with people, you're dealing with a long term relationship that you're building with your investors. And I couldn't have predicted or exactly built out a process that said, okay, I'm going to write this book, and then this book's going to sell this many copies, and then this book's going to lead to this. And because with people and networking and relationships, one thing leads to another that you could just never foresee. You know, you attend one event, and that at that event you meet this person who you never thought you'd meet, and then that person ends up introducing you to this person. You end up doing a deal here, and before you know it, like you're on a private jet. So investor relations and networking is just nonlinear in that regard. So I think it's a bit tougher, and
I mean,
it's
dumb
kind of,
luck too, right?
yeah, it's luck, but it's a bit 0 to 1. Like it's kind of really hard to get going, but once you get it going, then it kind of starts going for you. So I think that there's more magic involved with marketing and investor relations. You kind of need to catch that magic, but with asset management, it's just very like a grind.
Do you find one to be more rewarding, or does it sound like you think it's more rewarding to the capital raising? Or do you find that just to be maybe more fun?
I like the process of things. I like the challenge of things. I think that organizing things is really fun. So there's a lot of organizing to do in marketing. There's a lot of organizing to do in investor relations. Like when me and you are going through our investor database and we're kind of tagging people, categorizing things, and organizing stuff like that gets me going. I'm an organizer. And so
Hmm.
on the asset management side, there's also a lot of organizing. Like we have a portfolio. You have to organize that and allocate the properties with different asset managers. We've got our takeover team. We have to allocate where they go. We have property managers that work across different properties. We need to organize. It's like a puzzle when, this manager gets moved to this property. Well, now where does this manager move? And can they go here? So people are a puzzle as well. So I just like the puzzle of things. So I think it's, I don't really, I can't really pick a favorite.
Okay, that's fair.
But
And
what I will say is my introverted self does not like talking to people in that regard. So I do appreciate that you've taken a lot of that off my hands when talking to investors and having to do all that stuff. Because for me, that's like pulling teeth.
what would you, I guess, moving forward, how do you see yourself really allocating time? Because I think I know the answer to this, but I don't know if our people and I guess the audience and those who follow the company at large, where do you see yourself divvying up and spending time and putting your time in? And I guess organizationally speaking, how do you think will change moving forward? Because it's certainly not going to go back to how it was, let's say, a year ago.
No, for sure. So right now, my main focus is operations, asset management, and so on. And so I'd say I'm spending 80 to 90% of my time there. It feels like pretty much all of it. But yeah, I'm spending the vast majority of my time on that front because that's my focus. And I think, and so there's a point in that I want to address. But as a CEO, it would be derelict of me to do that forever or on a long-term basis. Like as a CEO, you can't just say, well, I'm CEO, so I have to oversee everything, but I'm just going to spend 90% of my time on one thing. That's just not how a good CEO functions, right? So I think on a long-term basis, as we look out forward, I need to make sure that I'm allocating my focus across all aspects of the business. And what's inevitably going to happen is, I think the way that I should be approaching the business is a bit in sort of like sprints and seasons, where right now it's the season and the sprint of asset management. So I'm just diving in fully. And I'm blessed to have great people on the team like you, Dosh, or Brad, who are allowing the other functions of the business to not miss a beat. But this season will end, and then I'll probably just go back into like a monitoring mode, just CEO mode, where I'm just kind of overseeing this, and then something will break. Like, or maybe not break, but we'll identify an opportunity. Let's say the next opportunity is in marketing, which I think it actually might be. And then I'll jump into the season of marketing and just go sprinting into marketing. And then I'll just wear my marketing hat for 90% of the time. And I'll be Russell Brunsoning it up and reading all the books and studying and testing stuff. And we'll be revamping the content. And maybe I'll write another book. I mean, sheesh, if I decide to write another book, like I'll have to dedicate a lot of time there. So I think that's how
what
I
you
see it.
do. I think that's the books thing. Sorry to cut you off. Is what you do once everything on asset management and property management is flourishing, and you feel, I guess, as good about where the marketing and acquisitions and capital raising side of things is on throughout the entire business. Not saying that there's massive deltas there, but it just, once you think everything is great there, then you can kind of probably put time into the next book. Which, do you have an idea for what that might look like for the next I guess, book that you would theoretically write?
Yeah, what you're saying is very logical. Basically, once my season of asset management is over, that doesn't mean I'm going to take my eye off the ball and
No.
neglect it. But once my season is over, where I'm not sprinting in this direction, then I could actually write a book about that season and talk about all of our experiences and improvements and best practices on the asset management and operations side. So that would be the logical next book, right? We went from book number 1 being about essentially acquisitions or kind of like underwriting.
Underwriting, yeah.
Second book about debt and equity, which is another aspect of the business, but still in the acquisition world. And then the third book, there we go, 1, 2. And then the third book would be about operations. That's kind of the 3 pillars of, I actually talk about in the intro of book number 2, Structuring and Raising Debt and Equity. You can go to structuringandraising.com to get the book on Amazon. And in the first chapter, I talk about the 3 pillars of a great deal. You've got the buy, which is basically essentially the price, but you need to identify a good acquisition. You need to have the right capital structure, because if you find the best deal in the world and you're getting a great price, but you finance it wrong with the wrong debt structure, or you've got punitive equity or so on, it's not going to serve you. But then the third leg of the stool is operations. So that third leg of the stool, right, we need to have a book on. So I don't want to commit to writing that book. I don't look forward to it, frankly. But if I were to write a third book, it would have to be about that.
Makes sense. But it's also highly logical to the point there of it making sense, I guess, on your end, and then what you think the best for the vision is. So very good stuff there. Not like we're giving any estimated time that would come, but it's just kind of a fun exercise to think about what is next and then on your time allocation. So, how much longer do you think the season will last for you here? Is it until you get to certain thresholds? What does that look like?
I think that it's going to be another 6 to 12 months, probably 6 months, and then a wind down 6 to 12 months, just depending on how things go and who we hire and things like that. But there's really no, I guess it's an interesting question, because the work is never ending. It's not like the work ends and then you move on, right? So and I don't really like to keep saying like as a CEO, right? Like look at me, the big shot CEO, right? But as a manager, one thing you have to be really good at is accepting chaos, accepting things as not perfect. Being a perfectionist is really a detriment to your ability to be a good manager, because people who are highly capable and perfectionists, they're always going to look around and say, I could do this better myself. And then they're not going to delegate. And then everything's going to be on its way to perfect, but never done. And so as a manager, you need to at times be comfortable with not even just like average or okay, but not perfect, but you need to be okay with fires. You need to be okay with something being on fire and being like, you know what? This is a small little trash fire. I'm just going to walk out of this room and I'm going to focus on something else. Obviously, if you walk into the living room and the curtains are on fire and there's, an explosion, okay,
And
focus
your
on that
kitchen's in
fire.
danger.
Yeah, focus on that fire. But if you've got like a little fire, you'd be like, okay, you know what? I've got bigger fish to fry. I'm going to go ahead. So prioritizing and being okay with things not being perfect is really important. So my point in saying that is, when my quote unquote season winds down on the asset management side, it won't mean that there's no more work to be done there or that everything is perfect. It just means that I'll be accepting of it and I'll be willing to kind of go into monitor mode and see if there's other opportunities that are more pressing in the business where we can create more value. So yeah, I think 6 to 12 months, just depending on if there's something else that pulls me. Like maybe I wake up one day and go, you know what? I have this strong pull towards writing the third book. Okay, I'm just going to wind down the season. I'm going to dive into that. So you just never know. I'm really lucky. One of the things that I'm most blessed by is I have this internal sense of priority where I can't even give myself credit, because I just feel it so viscerally that if I'm doing something that isn't the most important thing, my body will get sick. I will
It's
like be,
alignment.
yeah, I'll literally get physically sick if I'm doing something that's not, the priority. I'll get sick. I will be so lazy and procrastinate that I just won't be able to do it. And that'll be my like message to myself to realize, oh wow, I'm procrastinating on this really hard. That probably means that this is not important. But you got to be careful with that too, because oftentimes what you procrastinate is the most important thing, right? That's why they say get up in the morning and do the most important thing for the day, because
Eat the
often
frog.
eat the frog. I wanted to say eat the frog, but I didn't know if if people would get that. But yeah, eat the frog, absolutely.
Yeah, well, all good stuff there, and I actually can really relate to that because I've been in situations where I knew, whether it be at the brokerage I was at, the location I was living in, if someone was off, I like lost my will to do something, and it's happened for like this. Like if I make my mind on something, there's an internal thought. Maybe I don't see there's enough growth there. Maybe I see myself not being there for long term. We've talked about this concept before, but everything that I want to do with my life and time and energy has to have the compounding interest associated to it, the compounding benefit. And if I feel as if there's no compounding benefit to it, I can't wholeheartedly, in good faith, give it my all. And I'm an all or nothing person. It's either I'm in or I'm out. I don't really live in the in-betweens, and I'm not going to be floating through life. I remember the one job that I had outside of real estate, I identified really quickly. I'm like, okay, this is a placeholder. This is not it. I need to focus on the next thing, which is getting back into real estate. I had like a 9-month stint at a tech company out here and in Phoenix. And it's like, okay, this is what it is. This is not meant for me. This is not long term. I started getting my licensing, going from there and on to the next. So to that point there, alignment's huge. And I can't do something, as I said, that I'm not all in on, that I'm not fully focused on. And I too feel that same kind of feeling inside of me where, okay, this is in my gut, not right. And I don't want to float through life. I don't want to just make it by. I want to have an exceptional and extraordinary life. And if you have that mental standard and goal for yourself, and if you see more for yourself, I don't think many people can go forward in good faith knowing that that's not in lockstep with their future. One thing we talked about as well yesterday in the car, which was acquisition goals. So I think we mentioned the show before that we wanted to do 6 acquisitions a year, no more, no less. We've been telling all of our equity partners that's the case. Minimum deal side, with rare exception, of 40 million. Perhaps we go down to 30, in the 30 range, the 3 being the first number, if there's the event that there's a really good opportunity. But few and far between. We're buying, ideally no more or no less than than 40 million. But we can make rare exceptions. Maybe we'll bundle up some deals together. But that made me think about, okay, if we're doing 6 deals at a time and we're doing projected of 5-year holds, if my math serves me correct, that's about 30 deals in our portfolio at any time. So we had this conversation of cycling through owning and selling in an ideal world and opportunity. So can we kind of unpack that a bit more, and then also maybe go through, well, how does that make sense if the market's saying it's a good time to hold or sell, and everything in between, and then also what that means from a scaling up of human capital on the side that gets cumulative, which is the asset management and property management house of things.
Okay, sure. So what you're saying is if we buy, let's say, perfectly 6 deals in a year and the target hold is 5 years, that means basically from now to 5 years from now, we will accumulate 30 deals. And then in year 6, basically, we'll continue to acquire the 6 deals per year, but now we're cycling out of the deals that we bought 5 years ago and we're selling those 6. So you kind of spool up to 30 deals and then you're staying flat. That's kind of mathematically what you're saying. I think the reality is maybe not quite exactly the case, because there's going to be the desire to grow. There's going to be the desire to, well, if we're just because we're, let's say, even if it is we're buying 6 deals and selling 6 deals, we could be selling 150 million or 200 million of deals, but the 6 deals that we're buying that year could be 300, 400, 500 million. So the portfolio is still growing, which that's what I'd like to see. I'm not hoping for crazy growth every year in the portfolio, but I would like to see the portfolio to steadily grow every year. And but we can still have dispositions when we feel appropriate. And of course, big goal of ours is to 1031 exchange every deal. That's ideal. It's ideal for many reasons. Of course, primarily the tax reason is incredibly valuable. It's really one of the cheat codes of real estate, and how it makes competing with long-term real estate investing very, very difficult when you compare real estate investments versus other investments on a post-tax basis, which, funny enough, in the investment world, everyone's comparing pre-tax returns, but at the end of the day, all that really matters is how much money you keep in your pocket, right? Like, don't tell me what your salary is, tell me what you actually end up with at the end of the day. And with the post-tax returns, by leveraging 1031s, it's really, really hard to beat. So that's number one. Number two, it's a really amazing feature of our business, because if we're able to do a good job on a deal, sell it, make a profit, roll the profit into the next deal, and all those investors elect to roll into the new deal, well, that's amazing, because now we just were able to acquire a new property without really doing the heavy lifting of going out and finding new investors and raising the capital, right? The capital was already there, captive in our portfolio. So that's a really great way for us to be able to scale and build our business long term, and not have to essentially like hunt and get new investors every single deal, right? Like that's just no business. So that's the really important feature of the 1031 exchange. Now, of course, if we're 1031 exchanging deals, we've got, let's say, a $30 million deal selling, and then we exchange it into a 40 million, 50 million, $60 million deal, right? So the portfolio is growing that way. And then, of course, inevitably, we're going to want to have new investors. New investors, I would hope, would want to come into our program and join our company. And so that's going to fuel organic growth on top of just simply 1031 exchange growth. So that will fuel either the number of deals we do or the deal size to increase. And that's how we'll slow and steady grow the portfolio over time, while, of course, being able to match our capabilities on the acquisition side and the operation side. Of course, on the acquisition side, we need to not just be buying deals for buying deals' sake. We need to be buying good deals. So we need to be able to keep up with the demand, right? If we want to buy 4 deals, 6 deals, 10 deals in a year, and do some portfolios and packaging and whatnot, so that we're staying with 6 fundraisers per year, those are going to have to be good deals. We're going to have to work harder to find those good deals, and of course the bigger deals as well. And then on the operations side, we have to scale up the team and make sure that all of our processes, as far as hiring, management, like corporate management, construction arms, accounting, all those things need to be able to scale with the size of the portfolio as well, which I'm very confident that we'll be able to do. both of those things, acquisitions and operations. So I think that's going to work out very well for us.
I also thought too, so I would say our business model is less risky than it used to be from the inception of the company. But I do think we're going to start transitioning, let's say in a decade from now, to actually trying to simulate 7 year, maybe 10 year hold in certain markets with maybe a little less leverage, but higher quality, well appointed real estate. I think this year was kind of really a show with some of our tax exemption structure deals that are, really solid core plus almost opportunities. But at what point do we really make the bulk of our portfolio more of that longer term, hold there, more capital preservation, showing returns that actually don't show a 15 plus, but actually less than 15, 10 to 15% on returns, where we're really just showing you, hey, here's the cash on cash, over the certain period of time, and therefore being longer of a hold period, the IRR gets decompressed, right? So when does that happen? Will it happen? Is that a goal? Is that an aspiration for you see the future of the company to, have these, gorgeous, gorgeous properties that are likely 2000s and newer, penciling out with 10-year debt, we're putting maybe 30, 40% down, what does that look like, if ever?
I think 10-year debt is a little bit long. If we are doing 10-year debt, I would like to see it coupled with a bit more of an aggressive prepayment schedule just to allow us the flexibility. But I get your point. Of course, I think we are heading in the direction of buying higher quality real estate with lower risk and building a long-term portfolio where it's not a churn and burn. It's not a quick flip game. A lot of people in the run up of in the end of the last cycle got rich very quick by flipping deals, and it's not an easy thing to do, right? Buying and selling real estate is hard. Renovating is hard. Having the right timing is all hard, but it's a form of gambling because it's musical chairs, and when the music stops, boom, now you've got a lot of problems. So we want to avoid that, absolutely. And it's not worth it to us because real estate is not a get rich quick game. It's a get rich slow game, and it's a get rich for sure game. And so that's what we really want to align ourselves to. And I think we've done a great job of actually, like you said, we've pivoted a lot of our values and themes and strategies since the inception of the company. So I think we're already on that road to what you described as far as buying high quality real estate, taking less risk, thinking more long term, because the longer term you're able to think, the more de-risk, the less risk you're taking, right? So that's already coming to play. I think we're still some years away from buying truly core plus deals where we're underwriting to lower returns. I mean, the reality is where the market is today and the opportunities that are available, even core plus real estate is underwriting to nearly around 15% returns. So now is not necessarily the time to be talking about compressed returns, in my opinion, because returns have actually expanded quite a bit because we're at what appears to be kind of more close to the bottom of the cycle rather than the top. Now, what will be interesting to see for us, and I think really important to revisit this conversation and to have these themes in mind when we find ourselves near the top of the market again. Now, of course, we can't time the market, and I'm not saying
There'll be tells and fundamentals with where cap rates are at, maybe where
yeah,
debt's at, maybe with actually, I think the biggest tell is how many new people are getting into the industry. Like that will be the tell where, oh, wow, yeah, these deals are in vogue again. Yeah, everyone wants to do bridge, floating rate debt. That's the super du jour. That's the way to make money and get rich quick in real estate. Where's the new mastermind scheme? This, that, right? That will be the tell. I think we'll know the signs being, seasoned veterans with about 15 years of real estate experience at that point.
yeah, there will be signs, absolutely. So we're not saying we can time the market, but you can kind of generally know roughly where you are in the cycle. And so it'll be important for us that as we approach the top of the cycle where things get very compressed and returns get lower and lower and lower, projected returns go lower and lower and lower as the market gets tighter and tighter, it'll be important for us not to try to make up for those compressed returns by taking more risk and therefore being able to project the same returns as before. It'll be important for us to stick to our guns and say, okay, we get it. The market's hotter. We're going to actually not push up the risk curve in order to be able to project the same returns as we were projecting today, let's say, and when the environment was more favorable for purchase, we're going to accept that decline in projected returns, and we're just going to buy the safer deals with less leverage. And that's going to be the key to success, because we're going to be selling deals. If we're approaching the top of the market, it's going to be a great opportunity for us to be selling property.
And
So we'll
make
be
a
selling
really nice
deals.
return, but we don't want to lose out on the gains by making a bad swing trade. We don't want to trade, a deal where we made, a 20 IRR into a deal where we might, lose the capital or break even. We want to have a deal where, hey, maybe you 2x your money on a 3 or 4 year hold. Well, now, we're going to take your 2x money, and maybe it'll be an 8%, cash on cash kind of play, maybe higher yield there where it's almost like a debt instrument investing, return profile.
8%, sign me up.
Yeah, exactly. Well, but if we have less leverage, we maybe make the focus there. We don't know what the
No,
word is.
in the compressed market,
That's your
we'll be
yields do go down.
exchanging. We'll
Yeah.
be exchanging into a 4 cap, and we'll be financing it at a 4.5-5% rate, and there's gonna be no cash flow. Like, the life's not that easy. So, and see, like, when you say your scenario, it's like, oh yeah, that sounds great, and like you start talking yourself into it. But then when you stare at the numbers, like when it's the top of the market and you're staring at the numbers and you're like, oh, this looks horrible. How are we going to stomach this? That's how you have to be able to do it even when it's hard. And when you stare at the numbers and you're like, wow, this looks hard, you have to be willing to say, you know what, we're going to buy this deal on 50% leverage, and we're going to do 7-year, 10-year debt. At the top of the market is maybe when you want to do the 10-year debt, because when you're
I
at the top
agree.
of the market, right, you might have to ride it down, then you have to ride it up. So it's a longer period of time. So when you're at the top of the market, you have that feeling you might want to push out your maturity, obviously bring down leverage, and just be okay with accepting, hey, this might be a longer term hold and at lower leverage and at the top of the market. So those are all features to compress returns. But it's okay, because you're going to exchange into that deal, you're sheltering the taxes, and over a long period of time, a 10% IRR over a long period of time is actually a great return. And
Incredible.
then when the market turns again, like it always will, there'll be great buying opportunities like there are today, and the same high quality real estate will be on sale, and you'll be able to buy it for, instead of a 10 IRR, it could be for a 15 IRR, for a 20 IRR, and shorter term holds, and then you multiply that capital, and then you get it into long-term cash flowing scenarios.
Yeah, well, that's kind of the dream. That's the vision. So, with that said, what do you want the portfolio size to be at its peak from a number of deals, and then also total, I guess, assets under management, dollar size?
Well, I would really like for us to, in our 10th year of business, I would like for us to hit 2 billion in lifetime acquisitions. I think 2 billion AUM is a little bit too ambitious, because obviously sales are going to bring down the assets under management, but 2 billion in lifetime acquisition volume, I think that's ambitious but realistic to hit in our 10th year in business. So I look forward to being in our 10th year in business, quite literally having 10 years of experience, right? Being a tenured sponsor at that point,
Market
having two,
tested, cycle
right,
tested.
having 2 billion in AUM. That is a decent sized regional portfolio, and then have 10 exits, right? If you have 10 exits, you've got some track record to show, you've got 10 years in business to show, you've got some cycle experience to show, you've got a portfolio to show. That to me is going to be really validating, and I'll feel really accomplished in that 10-year space. So we're about 4 years away from that. And then on a more long-term basis, I would like to actually get to that 2 billion AUM mark, get to probably 3 billion AUM mark. And I don't think I mean, I don't know where our ambitions end. I think it's kind of foolish to have your ambitions end. I think you should always want growth, 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 because if you're
Well,
not
it'll be
growing, you're
different.
dying. But at the moment, I think, getting to 50 properties is a very reasonable goal that I look forward to.
Yeah.
But I don't dream of 100 billion, 100 properties, and take over the world and all this stuff.
I respect Rise 48. I mean, Zach Hamptonstall says it all the time. He wants to legitimately be the biggest real estate company. Okay. That's a wild goal. It's an
Not the
impressive
biggest
goal.
syndicator.
Yeah, they're the biggest real estate company. And I think they're
Yeah,
honestly, I don't even,
CBRE,
yeah.
Blackstone. It's
Yeah,
amazing.
exactly. So respect to them. We want different things out of our lives. I think we want similar stuff, but different stuff at the same time. So really respect their ambition there. That's not how I think we view the world in a sense. We obviously want to get big like everyone else. We want to have a great company. We want a smooth company. And we want enough where everyone I think is, financially happy for what they are making and there's no stress in many senses. And I think you de-stress by the product type that you acquire and the debt profile you place in the deals and the locations you're acquiring them in and the people you work with along the way. With that said, thank you so much for listening to this show. Uh, we look forward to, I think, doing a couple episodes, some guests coming up in Florida. So stay tuned for that. And we will see you I'll see you next week.